And today, like it's been over the last 3 months, like over the last 6 months, tech is in the green, but energy is in the red. Where do you sit in terms of the heave that some of these giant technology companies are trying to do to drag this market higher?
Well, it's not that the tech stocks are trying to drive the markets higher. It's that a lot of investors, notably retail investors, are pouring money into these what are often called FANG plus names. Now, what I think is interesting is the valuations are now stretched for growth relative to value stocks wider than it was at the peak of the tech bubble. Well, that was the biggest global bubble in history. And I never thought I would see valuation spreads as wide, let alone wider than at the peak of the tech bubble. But that's where we are. We're in a bubble. Or at least certain names are in a bubble. Now, the problem is betting against a bubble is very dangerous. Bubbles persist until they burst. A virtuous cycle of stocks rallying, drawing investor interest, drawing more money in, continues until it turns into a vicious cycle of money starting to flee. And then you can get a crash in many of the same names.
Yeah, I'm curious. I'm glad you brought that up. I mean, we were taking a look a little bit earlier at the NASDAQ 100. Right now, its forward PE at 28.2, which is basically the exact peak that it had back in December of 2004. So this is getting to some pretty lofty levels, at least on a narrow basis. I guess, Rob, a lot of folks would then point to Fed policy. They'll point to the weaker dollar. They'll point to a lot of these other metrics that are indicating support for risk assets. And I'm wondering, how do you sort of invest around that idea here that maybe some of the normal fundamental factors of the market are being skewed a bit by the monetary policy support?
Well, they're being skewed a great deal. I think we're skating on a knife edge. That is to say, markets can persist higher or they can break. Reduced spending by consumers, wary of the resurgence of COVID cases, are pouring money into markets rather than spending their stimulus checks. And those, it's well known that those who've been addicted to sports gambling are now pouring that money into stock gambling with considerably less expertise than they brought to the sports arena. There's also the issue of so-called TINA. There is no alternative with zero yields. If you're going to put money away, you may as well put it into stocks at any price. And retail investors, of course, are chasing the market darlings. Now, when fiscal and monetary stimulus don't promote spending, and these $3 trillion of stimulus and counting certainly don't seem to be promoting much in the way of spending. It goes into Wall Street, creating asset bubbles rather than Main Street. But at what price? When Amazon announced its earnings at the end of April, they closed that day at 111 times earnings. That's trailing earnings, not forecast earnings. One of my colleagues did a simple discounted cash flow model. He assumed Amazon grows at 20% per year compounded for the next decade. That's enough to make Amazon 10 times its current size in 10 years. 10 times. That would make it bigger not only than the entire retail marketplace in the US, but the entire retail marketplace globally. Now, if that were to happen, it's worth 70 times earnings today. Okay, so now it's stretched north of 120 times. Watch out, it's a great company. I get my daily Amazon deliveries, but it's priced as if it will be a world-straddling superpower bigger than the entire global retail sector.